Hello everyone, welcome back to my YouTube channel where I share very important educational content on how to trade the Forex market and become a profitable trader. Right, so today I'll be teaching a very important topic in Forex trading. If you want to be a successful trader, you must understand this particular topic that I want to, teach today. All right. So today I'll be teaching on understanding liquidity in the market. Okay. So before I go further, I would like to explain what liquidity grab means in the market. So liquidity grab is usually where it's something that happens in the market whereby smart money and the big banks, they push price to go above or beyond key support and resistance levels in the market in order to trap retail traders. All right. So when retail traders identify support levels and they want to take trades there, the smart money will move price beyond those levels where the retail traders are taking their entries in order to hit their stop losses and take them out of the market before the main move will happen. Okay, so if you're a trader here and then you have that experience most of the time, you see a very good position that you take in the market, but you observe that before you come back and check, price has dipped below that level or gone above it to take out your stop loss, whether for a sell or a buy scenario. Then you have to understand what liquidity entails. So that is liquidity grab happening from the big institutions. So for you to be a great trader, you must understand liquidity and how to identify it on the charts, because it helps with your entries, it helps you to avoid being taken out, and it helps to prevent you from being a victim of the smart money, which ultimately make you a profitable trader in the long run. All right. So I'll be teaching us today on the different types of liquidity that we have in the market, and I'd like you to follow me. All right. So the first type of liquidity that we have is what I call equal highs and low liquidity. Equal highs and equal lows. The second type of liquidity that we have is what I call induced liquidity. Induced or inducement liquidity, anyone is fine. Induced liquidity. Now the third type of liquidity that we have is what I would like to call MDA liquidity. MDA liquidity. I will explain what that means to us, right? MDA liquidity. MDA liquidity. So these are the three types of liquidity that we have in the market that every trader must understand and master if you want to be a profitable trader. One thing that helped me personally in my trading is that if I don't identify liquidity in the market, I will not take any trade. I won't take my entry. I only take entries when I have seen that liquidity grab has already taken place in the market. That way your trade is insured and then you are very confident that the trade will go in your direction. Okay. So first of all, I would like to, I will annotate some of these, um, explanation before I will proceed to the chart to show us real time examples. All right, so you have to follow me and then I will show you everything. So the first type of liquidity we have is equal lows and equal highs. So how does equal lows and equal highs liquidity happen? Now you observe that in the market you see candlesticks making patterns like this. You see, market to get to a place, it will be ranging. Follow me. To be making equal highs, equal lows, equal highs, equal lows, equal highs, equal lows, and then market will give a false breakout to the top side, right? And then it will move down aggressively. Okay, so what happened here is that while market was ranging, making equal highs and equal lows, equal highs and equal lows, equal highs and equal lows, traders were putting their stop losses at this place here, okay, at the up here. Many traders will be putting their stop losses here while the market is ranging. That is why you are not supposed to sell or buy in a ranging market. You should wait for market to break out, take liquidity before you enter. All right, so market is making equal highs, equal lows, equal highs, equal lows, and suddenly, because smart money knows that most traders are putting their stop losses above here, they will spike the market up, take out their stops, and then the market will sell aggressively to the downside. So this type of liquidity is what we call equal highs liquidity. Equal highs liquidity, because the people that are selling here, right, are putting their stop losses here, and the people that are buying, they have also put their stop losses where? Here as well. Okay, put their stop losses here, below here, put their stop losses. So when the market spike up, it take out the stop losses of the sellers, and then it sells aggressively to the downside, also taking out what? The stop losses of those that were buying. In that way, both the buyers and the sellers have been taken out, and then the smart money will sell from here, and market we go down aggressively. All right, hope that is understood. So this is for equal what? Equal highs liquidity. Now equal lows liquidity is something that is very similar to that. Okay, so you have market to be making equal highs, equal lows, equal highs, equal lows, equal highs, equal lows, equal highs, and the market will go down aggressively to take out stop losses, and then boom, it will start flying to the upside. Okay, so those that were taking longs in this market, those that were buying or taking longs, where will their stop losses be? Their stop losses will be here, below here. Okay, so the buyers in this market are putting their stops down here, and then the sellers in this ranging market are putting their stops here, above here. Okay, so that is why I always advise my students that you should not take an entry, whether a buy or a sell, when market is ranging or accumulating, because you are just preparing yourself to be a victim of the market. Because whether you sell or buy, you'll be taken out in a ranging market, okay, before the move will happen. So those that were buying here, their stop losses were where? Below here. And then suddenly smart money will just push price below this support level. Okay, push price aggressively, it will tap into another level here, and then price will go up, stopping out both the buyers and the sellers that were taking entries inside this ranging market. Okay, so this type of liquidity is called equal highs and equal lows liquidity. Do we understand? Now let me go to the chart and show you an example of equal highs and equal lows liquidity. Before I show you the example, I want to tell you that the best time frame that you can identify market liquidity is on 1 hour and 4 hour time frame. All right, 1 hour and 4 hour time frame. Those are the best time frame that you can identify, you know, market liquidity. Okay, so you can see an example of equal highs and equal lows liquidity here in this place in the market. Okay, so market was making equal highs and equal lows, equal highs and equal lows, equal highs, equal lows, and suddenly price what? Deep down, took out all these lows, and then it started buying. All right, so those that were selling from here, thinking market will go up, the moment market started buying aggressively, they were taking out. And those that entered buy early here without waiting for price to come to this main support, they were taken out of the market by this spike to the downside. So this is an example of equal low liquidity. All right, you can see those examples a lot in the market. If you go and check your charts, the examples are everywhere of such scenario. Look at another example of equal low liquidity. Look at it. Markets ranging for a long time. Okay, market was ranging, making equal highs, equal lows, and then price deep down, took out all these lows and started to buy aggressively. So that is an example of equal high and equal low liquidity. Is that clear? All right, so back to our lesson. The second type of liquidity that we have is what we call inducement liquidity or induced liquidity. So for induced liquidity, before a trade will happen, you will observe that maybe you have a level, you see patterns like this. Let me draw this. Okay, all right. So price will first come to somewhere like this, maybe like an SBR. Okay, this is a support break, become resistance. Price will come there and sell first. Okay, and then it will now go back up to the apex before the main sell. Follow me, right? So in this place we have two levels. This, the first level is down here, which is an SBR, right? Remember our last video, I talked about SBR, support breaks becomes resistance. So price can come to the SBR and sell, and later on price will now come to the apex, all right, before the main sell will happen. So this first sell that happened from the SBR is what is called what? Induced liquidity or inducement liquidity. So price will come here, sell temporarily, come back up to take out this high. So this high is the liquidity that was induced for this sell that happened in the market. Does it make sense? Do you understand? So this type of liquidity is what we call what? Induced liquidity, or some people call it inducement liquidity. Are we following? All right, good. So that's for a what? That's for a sell scenario. For a buy scenario, you can have situation like this, right? Have something like this. Okay, so then price will come back to the RBS, right? It will buy from there and then later come back to the where? Apex before the main buy will now happen. Okay, so in this place we have two levels. You have the RBS and the apex. Okay, so what has happened here is that price first came to the RBS and what? It bought temporarily, and then it later came back to the apex before the main buy. So this type of liquidity is called induced liquidity. It's a very powerful kind of liquidity that whenever you identify it, the moves that follow are very strong and powerful. Do you understand that? Yeah, good. Let's go to the chart and see if we can find examples of induced liquidity or inducement liquidity. Follow me. Where can I see an example? Where can I see an example? Okay, let's check back. Gold has been ranging a lot, so some of this kind of inducement liquidity are mainly found when you have a very trending market, right? So yes, I think there's an example here, sir, for this buy, this last place here. Exactly. So we see that this is a similar thing to what I just explained here. Okay, you need to train your eyes to be able to see. Look at this. So price, you have this, you understand, you have this. Okay, so price came here, it bought first, and then later came to the apex before buying. If I bring this out, you see that it's the same with the with what I drew earlier, right? So it's something similar to this. So the first buy from here, the first buy here is inducement, then it came back to the apex before the main buy. So this is an example of inducement liquidity. You can go over your chart and find multiple examples like that. Okay, the final type of liquidity that we have is what we call the MDA. MDA means miss, deep, and accurate. I will show you. Miss, deep, accurate. So under MDA you have something like this. You can have, markets will make a support level breakout to keep going up, right? Follow me. To keep going up, going up, going up, then to come down, come back down, come back down, and then it will come to the initial support where it started from the origin support, and then market will start flying to the upside. So this type of MDA is called, this type of liquidity rather is called MDA liquidity. So you have miss, this is the first breakout. So this one that wanted to come there is the miss. This is deep, 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 and this is the accurate level. So when price come back to the accurate, right, it gives confirmation and continue buying. So this type of liquidity is called MDA, miss, deep, and accurate. That's the meaning of MDA. Okay, miss, deep, accurate. Now when you go to your chart, such kind of trades, they happen a lot, and it might take a long time, but you always see MDA liquidity. Look at a very good example here of MDA liquidity. Okay, follow me. So you have this is the accurate level. If we change to the line chart, it will make more sense. Can you see that? All right. So you see breakout, miss, miss, miss. Sorry, miss, deep, deep, then accurate. Okay, breakout, miss, deep, deep, what? Accurate. So this is MDA, and then when it comes to the accurate level, when price comes to the accurate level, you see that it starts to buy aggressively after giving confirmation. Look at it, it touch it, and then boom, just started flying to the upside. So this is MDA liquidity. It's very powerful, and you have to understand. So these are the three main kinds of liquidity that we have in the market, and you must learn how to identify them. There are other kinds of liquidity that people, trade. There is trend line liquidity and others, but for me, These are the three main types of liquidity that I use and I apply in my trading, and it helps me. So thanks so much for watching this video. If today is your first time of listening to this video, or if you have not yet subscribed to our channel, please like this video, subscribe to the channel, and put on your notification bell for more videos like this. Also comment and tell me what you have learned from this video. Thank you for listening, and bye for now.